Welcome in this video. When will the XCN coin giant rally happen? We will analyze it. Don't forget to subscribe, like, and please watch to the end to understand. One of the most notable chart patterns is the bearish flag pattern. This pattern usually appears as a short-term correction and occurs after a strong uptrend. A similar pattern is observed in our current analysis. The price showed an impressive bullish momentum in the previous periods, and after this sharp upward movement, it started to consolidate in a narrow area for a while. During this consolidation process, the price moved between two downward-sloping parallel lines, forming a flag-like structure. This technical structure reveals a downward-facing flag pattern as a pattern. The most striking feature of flag patterns is the directional breakout after this period of compression. Especially if the upper band of the pattern breaks in volume, it is quite common for the price to resume its upward movement and gain as much or more momentum as the previous rise. This is because these patterns usually represent only a temporary pause in the larger trend. In the current situation, a similar picture can be observed. The price is moving within a distinct downward-sloping flag structure and is experiencing a buildup of energy. Such energy buildups are usually followed by strong and sharp price movements. The upper boundary line of the pattern is a critical technical level. If the price moves towards this area and breaks the upper line upwards with sufficient volume support, this will be considered a very positive signal in terms of technical analysis, because this would indicate that the selling pressure in the market is weakening and buyers are regaining control. After such a breakout, the price may move to new highs in a sharp and voluminous move, similar to the previous uptrend. Flag patterns are always one of the structures that traders closely follow and strategize. The main reason for this is that these patterns give strong clues about the direction of the price. This downward-sloping flag pattern on the current chart generates similar signals. It is characterized by the flag portion of the pattern, which consists of a sharp bullish move, called a flagpole, followed by price action that fluctuates in a narrow area. These price movements usually occur at times when traders are taking profit realizations or when the market takes a short rest. However, this pause is usually temporary, and the actual directional movement occurs after the completion of the flag structure. In the current analyzed situation, the end of the flag pattern may be near. This is because the price is hovering near the upper line of the pattern, which could be a harbinger of a possible breakout. If this line is breached, the price is likely to start an upward attack again. The target of this uptrend is usually around the flagpole. This means that whatever the uptrend was before the pattern, there could be a similar uptrend after the breakout. This type of movement offers traders significant profit opportunities. In addition, the fact that the price movements in this pattern are supported by volume is also a very positive development, because the decrease in volume during the squeeze period in the flag structure and the increase in volume at the time of the breakout is an important indicator that increases the validity of the pattern from a technical point of view. The current technical structure also supports this expectation. The gradual increase in volume may indicate that the breakout is about to come, and investors are focusing on this region. But we cannot decide the analysis only with the pattern. Let's look at other metrics. Keep watching. One of the most powerful theories for understanding the psychological and structural cycles behind the volatile movements of prices in financial markets is undoubtedly the Elliott wave theory. According to this theory, market prices move in a certain order and rhythm. These movements progress in waves and provide a model that reflects investor behavior. The structure observed in the current analysis points to the formation of an Elliott wave pattern on a larger scale. In particular, the current position of the price is interpreted as the second wave of correction and promising expectations for the third wave to follow. With the completion of the first wave, confidence builds among market participants. This first upward movement is often regarded as the beginning of a new trend. However, the second wave that follows is the market's process of digesting the initial rise. This wave of correction is a reflection of investors' profit realizations and short-term hesitation in the market. This is why the second wave usually includes some pullback. However, this pullback does not break the overall uptrend. On the contrary, it sets the stage for the next bullish wave, the third wave. The chart currently analyzed reveals that this large structure is precisely in the process of the second wave. Looking at the Fibonacci retracement levels, especially 0,618 and 0,786 stand out as potential endpoints of the second wave. When the price reaches these areas, it may encounter strong support, and this support may trigger the starting point of the third wave. In particular, investors are known to closely monitor these levels and consider them as buying opportunities. According to Elliott wave theory, the third wave is often the longest and strongest. This wave represents the period when investors regain confidence and the market generally continues its upward trend. Therefore, this third wave, which follows the second wave, usually brings with it a fast, voluminous, and sharp rise. There are many elements in the current technical outlook that support this expectation. In the event that the price moves into the third wave after completing the second wave correction, the Fibonacci expansion levels of 1,618 and 2,272 stand out as target zones. These levels are ratios that are frequently used in technical analysis and have provided successful forecasts in the past. Especially during the second wave correction, it is of great importance that investors do not panic and make an evaluation in accordance with the nature of the process, because this period usually offers serious opportunities for patient and conscious investors. As of now, the chart points to this opportunity zone. If the price finds strong support in the 0,618, 0,786 correction range, the third wave may begin in all its glory with the buying pressure from here. In this scenario, the bullish target would be a minimum of 1,618 according to Fibonacci expansion levels, and a more optimistic expectation of 2,272. Reaching these levels would imply a sizable rise compared to the previous structural movement of the price. Moreover, due to the nature of the third wave, this rise may create a serious transformation, not only on a price basis, but also in the general perception of the market. New investors may enter the market, volumes may increase, and market psychology may be completely positive. This increases the potential for the price to move not only to the technical target set, but even higher. In addition, the process of Elliott wave formation on a large scale is often more meaningful and reliable for long-term traders. Analyzing on a monthly or quarterly basis, rather than daily or weekly charts, reveals these large wave structures more clearly. Considering that the current structure is one of these large cycles, and that we are currently in the second correction wave, it is necessary to emphasize once again the importance of a patient attitude and strategic positioning. Bollinger Bands are an extremely important technical analysis tool that is often used by traders to measure price volatility in financial markets and to anticipate possible changes in direction. One of the most valuable insights offered by this indicator is the narrowing or widening of the distance between the bands from time to time. Periods when the Bollinger Bands begin to narrow usually indicate a market squeeze, which is usually followed by a strong and fast price move. Therefore, the narrowing of the Bollinger Bands observed at the moment is quite significant and noteworthy. This could be a harbinger that the price may initiate a strong directional move in the near future. In the current technical outlook, the upper and lower boundaries of the Bollinger Bands are quite close to each other. Such a tightening of these bands suggests that the market has been sideways within a certain price range for a long time, and traders have been waiting for a decision. Such periods are usually the moments when big players are preparing positions, and the supply-demand balance in the market is waiting at a critical threshold. Bollinger Band should be looked at occasionally. Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.